Hello and welcome to this session. This is Professor Farhad. In this session, we're going to keep working with adjustments, and specifically, we're going to move to the accrual sides of adjustments, and specifically, we're going to be working with accrued revenues. Now, bear in mind that we have four types of adjustments, four types. This is a review. We have two deferrals, which is prepaid expenses and unearned revenues, which I already covered. In this session, I'm going to start the accrual, and under accrual, I'm going to be covering accrued revenues. And in the next session, obviously, I will cover accrued expenses. So this session, I'm only focusing on accrued revenues. Now, obviously, if you want to go back and view the prior sessions, you can. You can have introduction to adjustments, prepaid and unearned revenues, which are deferrals. Now we're going to be moving to work with accrual. Now, bear in mind, so we know where we stand, we analyze transaction, we journalize transaction, we post to the ledger, from the ledger we prepare the trial balance, and now we are working on the step, preparing or journalizing adjusting entries, and specifically for this session for accrual. Okay. So what are accrual and what's the purpose of accrual? What is accrual? Accrual basically, did you accrue the transaction? Did you record? And what are you looking for? Here you are looking to find out, did you record all your revenues? Remember, under the revenue recognition principle, as long as you did the work, you have the right to recognize the revenue, to record the revenue. So accrual are made to record. That's the purpose of accrual, is to record. And specifically, since we're using revenues, did you record all your revenues? So revenues for services performed but not yet recorded at the statement date. This is what accrued revenue is. So you did some work and you have not recorded the revenue. So what do you have to do now? Go ahead and record it. Now, accrual also will have expenses, which we'll talk about later on. Expenses incurred but not yet paid. Those are accrued expenses. Just don't focus on this now. Just focus on accrued revenue because I'm going to cover each one separately. So how does it work? Revenues for services performed but not yet received in cash or recorded. So this is what accrued revenues is. So you did the work, but you did not receive the cash nor billed the client yet. So you would record the revenue now. So you record the revenue now, and you will get the cash. You will get the cash later. Now, what are examples of accrued revenues? Anytime you did any work and you did not record it, you have an accrued revenue. So accrued revenues often incur in terms of rent, interest, service performed, any type of revenue. If you did work but you did not bill the client, you have accrued revenue. At the end of the accounting period, you do record the revenue. Therefore, it's a revenue. Now, remember, maybe it's easier here to do a quick review. Sometimes what happens is we perform a service and we receive cash. So cash goes up, revenue goes up. And sometimes we perform a service, but the customer doesn't pay us. So we still recognize revenue, but what we do is we record it as account receivable. And this is the entry for accrued revenue. So receivable goes up, revenue goes up. So when you did the work and the client did not pay you, bill the client and make this journal entry. Okay. So the journal entry to record accrued revenues is the following. I just showed you. You debit an asset, and that asset is called account receivable, and you credit revenue. So asset goes up, revenue goes up. Account receivable goes up, revenue goes up. This is the entry for accrued revenue. So adjusting entries record the receivable that exists and record the revenue for the service performed. So this is what the adjusting entry does. It put the receivable on the books and it gives me revenue on my income statement. So adjusting entry will increase debit an asset, and that asset is account receivable, which is a balance sheet account. And it increases my revenue. Remember, we have to increase a balance sheet account, we have to involve a balance sheet account, and we have to involve an income statement account. We also have to increase revenue. We did increase a revenue or an expense. We increased the revenue. Remember, those are the rules, and no cash is involved. No cash is involved when you journalize entries, when you journalize adjusting entries for accrued revenue. So let's take a look at this example. In October, Pioneer Advertising Inc. performed services worth of $200 that were not billed in October. So we did the work worth of $200, but we did not bill them. So you're sitting at your computer and you say, oh my God, I did $200 worth of work, but I did not bill it yet. So go ahead and record it. Bill the client and record it. So I will debit account receivable, $200, and I credit my service revenue, $200. This is the adjusting entry. This is the adjusting entry. Now, on November 10th, next month, Pioneer received cash of $200 for the services performed. Now, the client, whoever that client is, let's assume it's a law firm. That law firm paid us the money. So we debit cash, obviously. Cash goes up. And account receivable goes down. So this receivable is eliminated, goes down, and basically the account receivable is gone. So this is an example of accrued revenue. And this is basically how accrued revenue works. Let's look at it from a complete picture. To analyze the equation, account receivable goes up, revenue goes up. We debit asset to increase it, therefore we debit account receivable $200, and we credit revenue. We credit revenue $200. This is how to journalize it. Then we post to the adjusting entries. We debit $200, we post to the account receivable $200, and we post $200 to the service revenue. Okay, so let me ask you what happened if we did not make this entry. So I always do this, so this way you know the effect on the financial statements. Let's assume this entry was not made. So this entry was not made. What would happen? Well, your assets are underreported, understated, or underreported. You have less assets. So you show less assets because you did not show this 200. You show less revenues. Your revenues is down. And if your revenues is down, your net income is down. If your net income is down, your retained earnings is down. And if your retained earning is down, your equity is down. So it's bad. So you want to make sure you accrue the revenue that you are entitled to. And this is basically a summary. So what can we accrue? We can accrue interest, rent, anything, any work that we did and we have not billed the client yet, we have to do it. So reason for adjustment, services performed but not yet received in cash or recorded. If we did not make the adjustment, account before adjustment, notice assets are understated and revenues are understated. Once again, if revenue is understated, I know I keep saying this, but this is important, then net income is understated, then retained earnings is understated, then equity is understated. So it affects few accounts. And the entry is debit an asset, and usually that asset is account receivable. So you debit a receivable. And the reason I say receivable, because sometimes you might have interest receivable, rent receivable, service receivable, whatever the receivable is, account receivable, and you credit revenue. And that revenue could be interest revenue, rent revenue, whatever revenue you are dealing with for that client. Okay, so the next session, what we're going to be doing, we're going to be working with accrued rather than revenues. We're going to look at accrued expenses. If you have any questions, any comments, by all means, email me or see me in class. Make sure to read your book, complete your homework. And if you're studying for your CPA exam, as always, study hard. It's worth it.